welcome and thank you very much for coming. I'm Jim Sterling of UBS, formerly Union Bank of Switzerland. Our moderator today will be Arthur Alunwa. Prior to joining MPC as Director of Investments, he was with Exelon as a senior portfolio manager with their investment office in Chicago. It's just turned 12 now. We're ahead of schedule. This is great. Arthur currently serves as co-chair of the CFA Society Distinguished Speaker Series. Born in Puerto Rico, our distinguished speaker graduated Phi Beta Kappa from Brown University in 1992 and went on to get his JD MBA from Stanford in 1998. A founder and managing partner of Thoma Bravo, he's moved the firm into software buyouts. And I don't know how he's done it, but he's managed to do more than 325 of them for more than $100 billion. Forbes has said he is Wall Street's best deal maker. Founder and chairman of the Bravo Family Foundation, which is dedicated to providing access and opportunity to young adults in Puerto Rico, he's committed $100 million to the Rising Entrepreneurs Fund in Puerto Rico. He's a major donor to Brown University, Stanford University, and a variety of medical research projects. He's on the board of Brown University and the Sloan Kettering Research Center. Please welcome Orlando Bravo.
Thank you. Thank you, Jim. Thank you, everyone. Thank you, Orlando. Thank you, everyone, for joining us online. I know you have hello to say to a bunch of folks in Puerto Rico, so I'll let you start with that.
First of all, thank you for that wonderful introduction. I really, really appreciate it. And Chicago, this is like my second home. So this is where I was mentored by Carl Thoma, Lee Mitchell, who's here, now our whole team. So I'm really excited to be here in person. And I did hear that the CFA Society of Puerto Rico is here over Zoom, so I want to say hi to them before we start.
Thank you. We're just chatting just before we started, Orlando. So I want to do a bit of your background in the founding of Thoma Bravo. But let's get a little personal. Can you talk about being born in Puerto Rico, starting off as a tennis prodigy, and if I recall correctly, you were roommates with Jim Courier? Can you talk a little bit about that, and then the founder of the company?
Well, that's as good as it got. I wasn't quite the prodigy, but I was his roommate, so I'll take it. I appreciate that. We were talking about your background, right before we started, and I think it's just very important in whatever you do, especially for young people, to be able to tell their story, because people want to buy from you. People don't necessarily want to buy from your company or because you have the better product. The short of it for me was, I grew up in a small town in Puerto Rico on the West Coast, in Mayagüez. And I did not grow up disadvantaged, but I grew up in an isolated place. And in order for me to try to do different things, I had to look at other places. And I do think that my background had a big part in helping me and our team look at private equity differently and get into the software industry. Right. So that was a big part of it. And then there was tennis, which so many people helped me along the way actually pursue a different journey than what was available in my hometown, and tennis was one of them. It was so empowering to be able to go to different places and be on a court with an opponent that may have had different advantages or different things, but when you got on the court, it was kind of an equal dance. And you got the feeling that you had a shot, but not only a shot, an equal shot. And that was really very, very inspiring as a young person for me. I think that sport, you know, you always draw analogies to what you do from what you did before. Tennis is so similar to private equity because no matter how good you are, you have to win the next deal.
Right.
We could have 100 billion under management and have done this and that, but how about the next deal? You start at zero and you face tough opponents and different challenges, so you have to constantly prove yourself.
Great. So speaking about deals, let's pivot into, you know, what you're best known for, which is deal making. But if we look at it, you only invest in one industry or one industry alone, which is software. Why?
Why not? It's the best place to be. That was really obvious to us 20 years ago. And I know the team from Messer is here. I saw Tom. And there was a time when we were becoming a software-only firm in 2008. And we tried to raise $1.5 billion, and nobody would give us money. Even with the great predecessor firm that we had, we ended up raising 822.7, you know, that we were looking for every dollar that we could find. And, you know, for us, when the reason why we started this is we said, you can buy recurring revenues with intellectual property protection much cheaper in software in the year 2000 than in any other industry that our predecessor firm with a long history had looked at. Cable, media, transaction processing, everything. Right. But it was even better than that because we had a theory that with 90% gross margins, these companies could produce huge cash flow, and they were negative. So we were able to take a bit of risk and embrace an operating principle with a lot of help from operating advisors to be able to make that happen. What the industry then has thrown upon us is, it was even more interesting. 5 years after we started, I remember we were doing this deal called DataTel in education software. Mm-hmm. It was our biggest deal at the time. We did it with co-investor partners. And I don't know, for most of you that have been in the industry for a while, in 2005, there were so many private equity groups buying for-profit schools, right? Which have not done well. Broken promises on jobs and salaries, yep. High tuition rates, financial aid broken, campuses, facilities, CapEx. And I remember walking into the company with Carl Thoma, and I mentioned to Carl, why would anybody buy that in education when you can buy the education software company that provides them all the systems that nobody can drop, that runs financial aid, that runs admissions, that runs the registrar's office, that can run all these things electronically and make a 50% margin with no CapEx? Why would somebody do that? You can extrapolate that to today. Where do you want to be? Do you want to own the infrastructure asset, or do you want to own whatever's taking that asset to the digital world that is part of that industry? And we think it's only really the beginning of that trend.
Good to know. But if that trend that you're talking about, so software was great before the pandemic. I mean, albeit we're still in the pandemic today, but it's even hotter now. And a lot of capital is pouring into the space. There's a lot of VC firms who are raising growth equity equity capital. So two related questions. Can you talk a little bit about the competitive landscape you see with all the capital coming into the space? And how do you ensure that you don't overpay for some of the companies that you invest in or maybe you buy?
Wow, okay. Can you give me a little bit of time?
Sure.
That was a good one. Okay, because there's a lot, we can unpack this. So look what happened in the pandemic. It was the third crisis in the last 2 decades in a big way that has hit all industries and the software industry being in it. At the beginning, there were a number of hedge fund blogs saying this time software is going to be different. They're going to get really hit by the fact that the world may have stopped for a period of time, okay? That was wrong. Software remained really stable. Customers could not drop those products, enterprise products, because they actually needed them more than ever to transact in a digital world when we weren't in person. That was proven also during the financial crisis, and that was even proven during the dot-com bubble, if you ran the companies correctly. But then by June and the beginning of Q3 of 2020, the industry took off. And why is that? It's because in Web 2, in software as a service and in SaaS, all the products have been available already. All the solutions are presented to customers, but the penetration is very low because the barrier is the customer's ability to be open-minded enough to absorb these products and think differently. And during the pandemic, not only society as a whole, but business leaders needed to embrace these products, to communicate with their employees differently, to communicate with their customers, to transact with them, to market to them. And we are not going back to the old world. It's going to be better going forward. See, SaaS is only at the beginning. It really started in 2011 and 2012. And the reason this is so important is from the beginning of time until then in software, software was very limited. It was limited to the back office, to reporting, to what we do in finance. Important, but it wasn't running the company. Once you move to the world of software as a service, it's not a capital expenditure item for the customer. So if you can reduce the customer cost or improve their revenues, they're going to buy it. They have infinite budget. You can implement it in the cloud almost immediately. You don't have to deal with these SAP, Oracle implementation cycles of 5 years. And the industry then became very creative in providing solutions that are at the center of the business and looking forward, not at the back. And that's why software, we always tell our investors, do not think of software as an industry anymore. And I think most of the world is agreeing with this now. It is not an industry. It is the business of every industry. We own Instructure in education. If you have kids that are students in K through 12 or in universities, that's the product Canvas that they use to communicate with the registrar's office, with their teachers, their syllabus, their grades. Instructure is in the business of improving educational outcomes. It's a software company. That company has nothing to do with RealPage that we bought for $11 billion, that is in the business of improving outcomes in multifamily housing. How do you price your units? How do you eliminate waste? How do you reduce water? And how do you provide a better relationship between tenant and owner? One is in the real estate industry, one is in the education industry. It's not an industry anymore, it's a business of every industry. As a result of that, you have more and more people coming in, not only from the venture side, but also generalists.
Hedge funds and...
Well, how could you not be coming in? If you're a generalist, you're going to have core competencies in industries. And you see your industries going digital. So you face that same question we faced. Why would you invest in that if you can invest in this? And you see the importance of it and the usage. The reason, the issue for us, and I feel the private equity industry, it's not competition from our peers. It's competition on two ways. The prevailing market prices in the public markets, because the culture in technologies, you all have to be public. That's kind of the success. That's kind of what you do. So you compete against that. But now the big competition is for size. Right. The software as a service industry has grown from 60 billion in 2008 to 2.5 trillion today. We're very focused at our firm in buying the market leader in verticals, in infrastructure software, and in cybersecurity. To buy the market leader, these companies now have $1 billion in revenue, $1.5 billion. They're still very fragmented, but they've compounded at a high rate for a long time. So you need a lot of equity to do these deals. If private equity doesn't keep up with what is going on in technology, our industry could get marginalized so that we have to buy the fringe, the niche stuff. And we're not really participating where the real action is and the real upside is. Now the other thing is our investors would ask, well, can you sell these companies? If you buy them for 10, 15 billion, how do you exit? Just not looking far ahead enough because our strategic buyers are so big $500 billion market cap. 300 billion, you look at ServiceNow, $1 trillion. They do not care about buying a company with $50 million in EBITDA, that's number 10 in their field, that's a nice little solution. They really don't care about that. I have nothing to say negatively around those companies. We're in that business too. They trade frequently in the private equity community. The capitalism creates new enterprises out of consolidation. But the big game is in creating these market leaders that then can be absorbed by the really big players that are changing the world. And that's what we're trying to keep up with. And that's our point of differentiation. In the last 2 years, when we all went into a hole in the last 2020 until today, we ended up buying RealPage for $11 billion, Proofpoint, the number one player in email security, for $12 billion, and I can go down that list. In one-on-one transactions with board of directors, in situations that were really, really special, and we thought were special to us.
So I want to pivot two things you just mentioned. One is scale, but I want to start with SaaS. So the average SaaS company is unprofitable. You've talked about, I think you even just alluded to it, that you're not in the momentum business. You're more in the fundamental business. So can you talk about, how your thesis is different from the typical growth at any cost venture capital model? Even some public equity managers go that. Can you talk about that? Then we'll go to scale later on.
So investors are the same in a certain way. We all want growth, we all want value, and we all look at quality in our certain ways. Where we can really, really differ is on what is your philosophy and what is your culture. Most of the world of technology, and it's such an arbitrage opportunity for us, believes that in order to grow rapidly in software, you need to lose money because that's called investing. The world doesn't work that way, and operations does not work that way. It's almost like corporations have convinced investors of this so that they don't have to price their products correctly and that they can deal with enough inefficiencies within their organization. We have a philosophy that we borrowed from our operating mentors many years ago, that actually the more profitable you are in software, because you have 90% gross margins, it doesn't cost you a penny marginal cost to continue to sell that product, except for your distribution engine that you have in your organization. The higher margin that you have, the higher you should grow, because you can take that cash flow and pour it back into sales and marketing, which is tactical, and R&D, which is strategic. And we have a way of working with our companies and bringing them to believe in this existing management so that they can continue to innovate and do what they're doing well, but also serve the shareholders through yield today. And that gives you a much longer time to provide long-term innovation for your customers. We do not understand how allocators of capital get comfortable over a long period of time with business models where the inputs are greater than the outputs, where the societal factors that go into production exceed the value of what comes out of that production line. It's not sustainable. It should not exist. It should exist from $1 million in recurring revenue to 20, 30 to 50. You may find a big investment opportunity, you should take that risk. And I'm really talking specifically about software, about the enabler and the digital part of the business. So that philosophy that we have is so strong within our organization that drives a lot of how we run our own business, how we interact with our partners, how we talk to our CEOs, how we collaborate with them, and how we are guided by all of our decisions.
Right. You talked a little bit, you said the industry went from 60 billion to 2 trillion, and you bought Proofpoint for 12 billion. How important is scale? And do you consider that a barrier to entry for other folks who are trying to come into the space?
Yeah, scale is incredibly important now because of what I mentioned before. In software as a service, it is very important to buy the number one or number two player. We use the example of cybersecurity. In cyber, our current portfolio has approximately $6 billion of revenue. We're the largest cybersecurity company in the world if you put them all together, by far, and certainly in the private equity industry. When you have a breach in your enterprise and you're the chief security officer, the first question your board will ask you is, not only the CEO, but your board, what product was breached and what were you using? You do not want to say, I was using the number 7 product in the market. And you do not want to say that you were using a free product. And I won't mention from what company it comes from. You want to be using the product that is the standard of the industry so that the CEO can call the CEO of all the other banks and they can figure out what's going on and potentially get intervention from the government and collaborate as a society. Buying the number 1 or number 2 player is very important. And for that, you need capital. Now, those players are so good at providing value to their customer and they have been highly innovative. But from a trajectory standpoint, they're not as efficiently run as the private equity industry is used to. So that gives you a lot of opportunity to try to create value when you partner with them.
You talked about cybersecurity, I think that's a good point to pivot here. I think I would be remiss if we don't talk about what's going on in Europe and I think the rest of the world to some extent with Russia's invasion of Ukraine. So, one of the things that was talked a lot in the press is about the cybersecurity and potential cyber war from the Russians against the U.S. So I have a number of questions here to ask is how do you rate U.S. companies' ability to defend themselves in the cybersecurity space? I think you just mentioned you don't want to be using the number 7 player, you want to certainly be using the top one. And then what advice do you give to founders? And then maybe lastly, what opportunities are there in the space? I know there are 3 questions I'm throwing at you. We rate it as medium. Companies are certainly trying. There are just so many challenges. One is roughly half of your applications today in the world are on-premise. And those on-premise applications have certain cybersecurity companies that protect those applications. Then there's the next world, the SaaS world. That's about where half, and it's moving more towards the cloud. But the SaaS world has its own cybersecurity issues and its own set of companies protecting those. And these 2 worlds don't connect very well with one another. So what the industry talks about now is what is your cybersecurity posture? And companies expect to be hacked. Preventing an attack is no longer the top priority. Is how do you make sure it's controlled and how do you deal with it afterwards? And there's a number of products and procedures and processes that you put in place to deal with this. When it was about a month ago, our teams saw we call it DDoS, it's denial of service, where in essence you have infinite number of robots attacking a website so that it goes down. We saw from Russia the number of DDoS attacks coming were 10x pre-conflict what they had been before. And some of the best technical teams, some of them who work with us, tell us that they do not understand how they could do them this quickly at that scale. That's how sophisticated these nation-state attacks are. Now, that's part of the conflict because the world has gone digital very quickly, and cybersecurity is trying to keep up with that as well. So that's a big area of vulnerability. In the next month or so, we should be, unfortunately, reading these big headlines. In the US, banks, energy companies getting compromised, and what ramifications does that have for the stock market and for values and for what's going on in the economy? It could be severe, really. I remember in 2008, we did our first cybersecurity deal. It was a company called Entrust in Texas. And we were taking it private at $2 a share right at the bottom of the financial crisis. Hedge funds were in complaining. It ended up being a great deal in identity. Then we very quickly bought SonicWall for $547 million, a company in Silicon Valley
that provided really firewall security. Identity is inside and firewall is what happens outside of your enterprise. And then we were doing another one, and I remember asking Carl Thoma, are we doing too much cyber? And way back when he said, you could never do too much cyber. You can never be overexposed to it. I thought that was just so incredibly insightful. We've always been guided by the deal.
Right.
That's been the best, just do the best deal in front of you, and those were the best ones. But we didn't have this enormous theme that has evolved now.
So when nation actors hack a company, the typical ransom is in cryptocurrency. I know that's an area that you like. So I want to talk a little bit about, when they, either cryptocurrency, blockchain, and Web3. So I'm going to go through each one of them differently. But I'll start with crypto first. What was your aha moment for cryptocurrency? When did you start to like it, or and it's grown significantly? But just want to get your thoughts at the start.
I have many aha moments. One of the biggest ones is when you see young venture capitalists that are really smart, that are the future of the industry, are next generation leaders, and they all want to do crypto. So that's where a lot of the capital is going to be allocated, because whoever they're reporting to, if they continue to tell them no, they're going to go elsewhere and they're going to do crypto. It's just the way it works. And then when you look at some of the best developers and the best minds, they're leaving these garden walls of Google and Facebook to go into developing interesting applications in this new environment. So the more people I met, about a year and a half into the pandemic, I said, this is just, it's going to happen because it's where people are going. Now, personally, I am a big fan of the movement of what it means. It means being decentralized. It means less intermediaries. It means equality. It means peer-to-peer. It means less intervention. All of it, and all of it is the same theme. And it's really empowering. And at the end, when you look at NFTs and crypto, young people today want their own culture and they want their own financial system. And they're going to create it. And it's going to crash at times. There's going to be breaches at times. There's going to be fraud. There's going to be bad actors. All that's going to happen with this new creation. But it's going to make it. And it's going to sit alongside governmental and great financial systems. And I think policymakers know that. They wish it did not exist.
Right.
Because it provides less control. But that's exactly what the movement is trying to do. And in a way, that's why it hasn't been regulated for so long. It's like, let's kick it down the road, let's see what happens. But now, I think you see more buy-in from policymakers in terms of having to really embrace it.
So so the cryptocurrency obviously runs on blockchains, and you have Web3, which is also another important thing, development today. So what kind of companies do you think, or ideas do you think will be possible with blockchain, 5G, and Web3 that were not possible before?
That's such a good question, because it's what's possible now that wasn't possible before. Okay, so stock ledgers. Why don't you have what everybody owns in the blockchain? Why do we have to search who owns the stock of this company and how they're voting? It's so complicated. Title to a house, title searches and title insurance. Why isn't that on chain transactions? When you do due diligence on a company, can you imagine if that company has everything on chain? You can look at its daily reports, by the minute, what customers are buying and what the momentum is of sales of that company. There are so many interesting use cases. We used to own a company called Sparta that provided quality management systems to pharmaceutical companies so that the regulators could come in and ensure that the processes that are being used in the manufacturing process of these important drugs are up to FDA standards. Why isn't that on chain? Why couldn't that be on chain? Right. And then you enter into more societal use cases. Like there's one recently where these two companies are looking to develop a way to pay hourly workers by the minute that they work. So if you're in construction, if you are a subcontractor that gets stiffed out of jobs and somebody goes out of business, you receive your compensation. If you're a waiter at a restaurant or a waitress and you are in minimum wage, you don't have to live paycheck to paycheck. You're seeing how your labor is appreciating over time. Now, could some of these applications run on database? Yes. But the fact that there's this movement is causing people to be more creative and come up with new ideas that apply to an on-chain world very well. And that is value that we'll all receive over the years.
So in the blockchain part, but I'm going to go back 1 second and come back. So when you look at a lot of the intermediaries today, I don't know where's the value. Is it in the currency itself or the intermediaries? You've seen Robinhood and Coinbase, all those values have been cut in half or maybe more. So where is the value in this? Is it in the intermediary or in the currency itself?
I think it's both. The intermediaries, which run a little bit counter to the movement, because how come they're intermediaries in this peer-to-peer movement anyway?
Right.
We are not allowed to invest in the tokens, okay? Now we can invest in stock as a corporation, and there's where you have intermediaries like staking firms and trading firms and a number of others. My answer to their drop in value is very simple, which is every one of these growth things has been cut in half or more in the last 6 months or so.
Yep.
It's been a really tough environment where investors are finally looking at fundamentals. There's sometimes an external shock that's needed for people to pause and be a bit more thoughtful, and we've had plenty of those that have allowed that. So they're in that group of high growth companies that has come down. As for trading firms, look, for people that want to have fun, and trading for some people is fun, it's utility. It gives them that value of belonging to a system, of speculating, of having fun. It's not irresponsible. It's what they want to do with their money. What is more fun, trading crypto or trading New York Stock Exchange stocks? They're going to go more to these platforms. They're going to get more volume and more volume. We may not do it in this room. We may think differently about our money and our responsibility or what it means, but other people that like to have fun in the system, and there's plenty of day traders in the New York Stock Exchange and the NASDAQ, they're going to be moving more and more to these platforms. And I think they're going to be much bigger in the next 2 years than they were this year, even if the underlying value of some of the cryptocurrencies decreases a bit.
I'd like the audience to participate. So while Kim is at the back, pass the microphone around. I have one question while you all gather your thoughts. Could you talk a little bit about your views on the role of DeFi and how you think it's supporting Web3 and potential it could have an impact going forward? And if you have any thoughts on that?
Well, DeFi is like the monster of all use cases for Web3, for peer-to-peer financial transactions. So that's where you see most of these DeFi applications and use cases being built on top of Ether and Sol and some of the other layer 1 or layer 1 protocols. There are many interesting ones, and there's many that will make it, but I think it's once again this movement questioning why financial transactions are the way they are and can we do things better.
Okay. Kim, is there any questions in the room?
Hi, I'm Bill Florida from Advisory Research. Thanks a lot for all the good points. And just a question, I know you guys had done a SPAC transaction. I wondered, what is your experience so far with SPACs? Do you view that as part of your toolkit, part of your solution going forward? Maybe what are the strengths and weaknesses from your point of view?
Yeah, great question. What we saw in the last, so that 2-year time frame is just so important in the world in terms of software, in terms of Web3, and in terms of how the financial industry has looked to solve how they finance this huge world that one has crept up and the other one has compounded in growth. And as part of our financial system figuring out how to finance these things, one of the things that you saw is what we call the worlds colliding. And you alluded to this, Arthur, is venture capitalists coming to do growth rounds, venture capitalists doing public transactions, hedge funds coming into growth equity, coming into venture capital, everything coming together. And the private equity and buyout industry really doing growth buyouts, which look a lot like growth equity deals. So the SPAC is just an additional form of the world figuring out how to transact within this innovative set that you have of companies. We think that there is great room for phenomenal owners that can help these entrepreneurs build their businesses while they're going public. How to miss their numbers, how to talk to their investors, how to do acquisitions, how to manage their restricted stock, how to think about leadership. All that, because these things have been formed so fast. So instead of going public on your own and doing the beat and race game until you fail, having a great owner that can help you is a good thing in the public markets, because there's some that want to be public, there's some that don't want to stay private or be acquired by private equity. And there's a need for liquidity as well. So we think there's a space for this. Also, or maybe part of the problem is, since the retail investor cannot access venture capital and private equity, the SPAC became their room to participate in these earlier stage companies, creating a speculative bubble, which the regulators don't like anyway, and which may not belong in the public markets due to transparency and disclosure and the way these things are set up. For us, the SPAC that we did, we partnered with a company called IronSource. IronSource is a phenomenal company based in Israel that is the software system that powers all gaming engines. So if you're a creator of a game, you be the creator, you be the artist. IronSource will run all your marketing, all your usage, the way to monetize your art. And they do that very effectively. Last year, the company grew organically over 60% and delivered over 30% EBITDA margin. Since we did the SPAC, they have crushed their numbers every quarter. But the stock is way down. And the market doesn't like SPACs. So we won't be doing one anytime soon because nobody likes them. But that may change in the next few years.
But to that question, though, is it that the market doesn't like them, or is it the structuring? You know, there have been some SPACs that had really poor structure, and the incentive structure is set differently. You know, you've seen it at CNBC runs the SPAC 50, and if you look at the list of companies here, the incentive structure is set differently. So how do you structure a SPAC properly? Maybe to that point.
Yeah, we wanted to rally the industry around this, and nobody listened to us. Okay. So I'm really happy that you asked. You look at the concept in private equity, and we put those in our SPAC. One is alignment. How much is the SPAC sponsor investing hard dollars in the deal? And our organization collectively, we were the biggest holders of the pipe investing in it. The other one is transparency. Who is the SPAC backer? And give me the entire track record of the SPAC buyer. We cannot do that because we're not allowed by regulators. So the investor in the SPAC cannot differentiate. Maybe they want to invest with somebody that it's their first deal ever because they're hungry. But say that. Maybe they want to invest with somebody that has invested at these great rates of return for 20 years. So let me see that. But that's not available. And the other one is accountability. Have the company always report back to what its original projections were and show that. I told you in Q2, Q3, over this 2-year program, this is where I am versus projections. If you put that in the market, which is how LPs look at us, how much are you putting in a fund? What are your numbers? And if the deals are not going well, let's sit down and talk about them. Those are great principles of alignment that you could put together in the SPAC contest.
Is there another question?
We have a question from Charles online. He said he knows that there are several students from Puerto Rico viewing this right now and wants to know if you could give some advice, especially to those students in Puerto Rico, about getting into the field and how to learn about Web3 and other new technology.
Yeah. Make a lot of calls. Get out there, and people want to hear from you. I have found that the Web3 environment is very open. When I was making those calls, people would have a reason not to take them. They may not want us learning about this stuff that they're doing. Stay in your field, which we are. I mean, we have our game that we know how to do very well, but we're interested. But get out there, and people are very open to talking to you and to helping you. That's part of what Web3 is about. It's about making this an international community, actually. It's what the internet was meant to do. Distributed system where you can create a business out of anywhere. So it's an empowering system. Secondly, take risk, and I know it's hard, but be a risk taker. It's hard with less resources. It's hard because you need your job. It's hard because you need to make ends meet, but you'll figure it out. You're better off taking a risk, especially as a young person.
Is there another question in the room?
Hi. Healthcare is such a huge part of the economy right now, and I'm wondering, to what extent is there scope for software solutions to create greater efficiencies and reduce costs and better outcomes, et cetera?
Huge. We have some of those. Let me give you an example. In Provada is a great company that we own that provides security software to hospitals and healthcare practitioners within those environments. So if you are a physician, if you're a nurse, you go into a hospital and you only have to log in once, and you're allowed to do only what you do, what your role is. Prescribe only what you're allowed to prescribe, see the patients that you're allowed to see. You know when you go to the hospital, how many times they have to log into the machine and you waste like 10 minutes of your time and their time? Imagine if in that 30 minutes that you have with your physician, that 10 minutes is gone. That is a huge efficiency boost to the system where people can spend their time more productively. It was extremely helpful during the pandemic when healthcare practitioners were running from hospital to hospital. How do you know it's the right physician? How can they get quickly into what they do, which is quality of care and taking care of patients? Healthcare is a very slow adopter of software solutions. And there's a lot of old systems in healthcare and old processes. And it's just a long sales cycle. It takes a long time to change it.
One more question.
Orlando Bonfrench from Adam Street. Just an observation and then a question. What you've built is incredible, and the returns you've generated for LPs is incredible. I don't know if people in the room understand the magnitude of it, because I remember speaking with you 10 or 15 years ago when things were a lot smaller, and Thoma Crescent Bravo or whatever. But did you ever imagine, so there's two parts of this about growth of the firm and the private equity industry itself. Did you ever imagine that Thoma Bravo would be as big as it is today? I think you've raised, I don't know, maybe 18 billion or just in the last year or something like that, between the Discover funds, Explorer funds, the Growth Fund, the Flagship Fund, and the current fund I think is 22 billion, maybe capped at 24. So what do you think the next 5 years is going to look like, both for Thoma Bravo and maybe the whole private equity industry? Because a lot of what you're talking about does apply to other firms that focus in other industries, may not compete with you, but we've just seen such a shift over the years in terms of public to private investing.
Thank you for those nice comments, and I remember all those meetings that we had. when I was learning the business and being mentored, and I learned so much from you, from Tom, from our other investors about what matters and how you can do things. And I really, really appreciate that and your support. First, it wasn't in the business plan. I never imagined we would be even a tenth of this size at all. And we didn't think about that way anyway. We thought about what is the best deal to do and go get it and go do it and have the journey with management be a good one and have that be successful. That's why we stayed in software, because every time we looked around a bit at other industries, we go, no, this deal's better, let's keep doing that. And there were all kinds of concerns around it at the time. Microsoft is going to put you out of business. Software's not going to be what it used to. You're going to be a sector-only fund, and how about if investors don't like sector-only funds? All these things. Now software has become the entire business, and investors are mostly comfortable with that, that those issues have gone away. But the reason we were able to get through that pretty quickly is do the best deal. I know it is as clear to us right now that what we're going to do in the next 5 years is so much bigger than what we've ever done before. The position that we have is so good now. Before, nobody would return our call. We couldn't do anything. And we were buying these fringe little companies. Now we get to buy and partner with the best. And the more you go at the higher end, the more room you have to have proprietary discussions with people to make sure your chemistry is right, versus a lot of noise that happens here. The challenge for the industry is how much capital will institutions allocate to private equity? Because also in the last 2 years, since people were so bored anyway, and we weren't on planes everywhere, we just did all these deals, and everybody put their money to work, and institutions get stressed by that because they have their pockets. So would institutions ever think about, I want to be in this general area, and I don't mind that much if it's public or private? That would change it. I think that's really the limiting factor. Where we have to be a contrarian is to all the great investors in our industry know that bigger is not necessarily better. It's been the other way. Return software and
Right.
Not in software, because the big companies need as much help as the smaller companies, and our industry can provide that really well. I hope that gets to some of it.
Okay.
We've got a question from Wesley online. He said, could you please give us the thoughts that the value of Thoma Bravo places on the people aspect of software solution? Example, do you think it's a key part of the value proposition of a software provider to a customer to provide accompanying expertise people for the customer?
Okay, sorry, what was that? The value that we place on our own people, or the value?
He says the question here is set in the context of there being a dearth of cyber professionals who are able to operate and implement technologies effectively for the end user. However, it has relevance for all software solutions.
Okay, maybe I'm going to try to guess. I think maybe the professional is coming from the perspective of being a great implementer of product to the customer.
I think that's what I
Right?
sensed from
Rather than a developer or customer support or engineering or sales. We place huge value on that, actually. My operating mentor 20 years ago, when you could offshore some of these things and give them to partners, the implementation, and many Silicon Valley companies don't want to do this themselves, don't place value in it because it's lower margin. It's complicated. Let somebody else do it. My operating mentor told me, do not outsource that, because if service and quality is a core competency of your company, you need to control that yourself. And how that product is implemented and used has big implications for how valuable it was for the end customer. And for you, how you can continue to sell them more, innovate with them, increase prices as you add value to the product. It is absolutely critical. And one of the things we do in our companies is we usually find that area of the business has been an afterthought, is unprofitable, and no wonder why they want to move it off their plate. We can generate really good margins on that because we value it so much that we're not into giving it up for free so that we can make it somewhere else. It has so much value that it runs as its own P&L, and the customer understands that because they're commercial entities if you explain it correctly.
I'm interested in time. I have a couple of quick fire questions that I think I received from a number of accounts online. Oh, there's a question over there? Sorry, Kim.
Sorry.
That's okay. I got it. It's quick fire.
Oh, no.
Hi, I'll make this quick. Over the last few years, the new IPOs seem to be much more SMB focused in software. And if we compare that to about 10 years ago, it was much more enterprise focused. So I'd be curious to learn from your experience, has your transactions in SMB businesses changed more recently than it was 10 years ago? And are these more sustainable or similar quality businesses to the enterprise software companies? Thank you.
That's an incredibly insightful question because what you have seen in the last 5 years or so is SMBs adopting going digital quickly, but there are a number of companies that have a lot of velocity that have developed easy-to-use solutions, priced for the SMB market, that can be implemented very easily, that fit that market. And that when you do it in the SMB, you get a lot of momentum. You have a lot of velocity. And that has been a big IPO crop that has grown. Are those lower quality than the big enterprise? Not necessarily. And we worried about them because we have a number of these in our portfolio during crisis situations when 20% of your customers go out of business. Right? The big companies kind of don't go out of business typically, and the little ones just change a lot. And your retention rates are lower, at least your gross retention rates. But that's not necessarily the case because you need to you need to be open. Look, the whole market knows what a good gross retention is, which is 93%, and a good net retention is 110, 120, and that's kind of their black box. But in those SMB ones, you need to look at their business a little bit deeper than by just looking at those things, because their velocity and their ability to acquire new customers. For example, if you have a customer that's an entrepreneur and you just lost them, that's a drop. But that entrepreneur just formed a new business 6 months from now, then you got a new win here. And it didn't cost you that much because you may be able to have gotten them online. Is that a retention or is that a new win? So if you look at it by different lens, it could come close to the same quality as the ones that are serving the big enterprise. The big enterprise, on the other hand, they look more stable. They look more steady than that. But you're also at the whims of some big customers. And those companies are much smaller than their huge corporate buyers, so you may need to be a lot more flexible on pricing, on professional services, and in other functions with them.
Great. Thank you. I'm conscious of time, but one of the things that Jim mentioned, and it was introducing you, was your philanthropy. I think I would be remiss if I don't talk about that a little bit. You gave $100 million to Puerto Rico to help to bridge some of the income inequality, help that. I have two questions there. Why Puerto Rico? I guess it's where you're from, but also, what do you think can be done more in this space to help? Is the government lacking? There's also some stuff there. And then second, why do you think other investors are not invested in minority places or platforms or even people?
Yeah, look, Puerto Rico for me is personal, right? I'm from there, and I was given so many opportunities. I've never done anything on my own. And I was given so many opportunities by others. Everybody just carried me through. I think the best thing I did was listen. And then kind of choose within my own value set and what I was getting taught, then you kind of choose your own path. So our foundation in Puerto Rico is, our mission is to have an environment where every young, talented adult has a chance and an equal chance. We run a number of programs. We run programs in disadvantaged communities. We do it in high schools. We have the Rising Entrepreneurs Program. And we do it all in-sourced. We don't work with charitable organizations in the island, not because they're not good, it's a very fragmented environment. So we want to also be able to build and control our own program. So we have an excellent team in Puerto Rico that does this. We have seen incredible entrepreneurial talents. Going to your question on how come there's not more investment in minority communities and what's limiting that? There's a lot of entrepreneurial talent. We have a group of CEOs from Thoma Bravo, advisors from Thoma Bravo, and from other entities that year after year they come back and they tell us this is awesome, and everybody returns and everybody comes in to do the same program. They're really inspired by these entrepreneurs. There's just lack of money. So a big problem is when these entrepreneurs really need to get going, it is very hard for them to commit 100% because they need a safety net. Right? It's not like Silicon Valley where here's a Series A of $10 million, you have 3 years of runway, go get it done. It's like here's 100,000, you try to do whatever you can, and it just doesn't work. How does that change? We're trying to change it. In the last couple of weeks, we had a group of 10 phenomenal VCs, of the best VCs, come to Puerto Rico. They spent a week there, 2 companies got funded, and maybe little by little, you get this going. But there needs to be a combination of philanthropy and capital, just taking the risk and committing. And once you get 3 or 4 role models going, then you really see a path to it. Then young people can say, oh, that's my path. I can do that as well.
So I want to pivot on that question, though. So your team, who've been great, Megan has been amazing helping me prep for this. So without putting her or the rest of your team here on the spot, what characteristics do you look for in people? You talked about just now about the kids in Puerto Rico. But in general, when you're hiring people or you're partnering with people, what characteristics do you look for?
Yeah. I always use the quote that in private equity, culture is not the most important thing, it's the only thing. Given the number of changes that our phenomenal predecessor firm had, we were incredibly sensitive to having zero turnover, like overly so maybe, like really, really taking care of others. And if we look at when we have gotten lucky, we say, why did we get it maybe a little bit more lucky than somebody else? All of our team always comes back, it's the culture, right? It's not our metrics or processes. Yes, we've been in software, right place at the right time for sure, but many others have also been in software. Bon, you remember there were about 7 or 8 firms when we started, and many of those are kind of not in the space anymore. So we go back to culture and culture. It's actually very straightforward for us. We look for 2 things. Give us a good person. Something in their past that you can point to and talk to them where they have come out the right door. And most people are good people. We look for people that really go out of their way for others. Not only because that develops that environment that we have, that's one of our key attributes, collaboration, but that is the way we work with our companies. We need to inspire existing management to think differently by collaborating with them, not by changing them, firing them, criticizing them. We try to find what is the best in them so they can do more instead of having them do something else. So we look for people that are very, very good people. And second, we look for people that have a strong opinion on something. We may disagree. It may be unrelated to tech. It may be unrelated to private equity. But give me somebody with a really, really strong opinion, because there's a lot of innovation there. There's a lot that they can do. There's a lot they can challenge as the world continues to change. And for us, our philosophy has always stayed the same. We believe in this so much. But our tactics, the companies we buy, now they're SaaS, now they're growth, they're totally different than they were 20 years ago. And that comes from those people that you hire that are willing to challenge and create.
I'm interested in time. I'm just trying to squeeze one last question in, and I know you have a hard stop, so I'll be quick here. You've also talked about, I think in a recent article, I think it was Bloomberg, you talked about your team is decentralized. So I want to ask, how do you, why, how do you motivate your team having this decentralized? We're in a process now where it's going to be 2 days at work or 3 days in the office. So I know you've recently moved to Miami. So how do you manage your team and motivate your team, that you're decentralized, outside of compensation, of course?
Yeah, and compensation is never the factor for turnover. By decentralized, see, what we do is, since I was given the opportunity to have this journey, I'm also very sensitive to having all of our colleagues have their own journey so that they can get to a position of leadership. Kind of, I owe that to our colleagues. That's one of the reasons why we've kept our team relatively small versus equally sized competitors. It's not because of resources, it's because if you have 1,000 people, how could you do that with a straight face with 1,000 people? But by decentralized, we run our company just like we advise CEOs to run their companies. Give responsibility, authority, and accountability to people that are closer to that business than having everything flow to the top. If you have everything flow to the top, you may think that it's because of what you've done, but you're probably getting in the way. The company may be doing well in spite of what you're doing. You have to be humble enough to understand that. And with our divisions, for example, one of my biggest fears in investing is you're looking at this company and you're trying to figure out what are they about, what's their culture like, what's the data telling you, how well are they doing versus the competition? Are these numbers, operating numbers that are forward-looking, are they telling you what you're hearing? Does this make sense? So think about it. You have a company. The operating metrics are given to the CFO. The CFO does something with that, then gives it to an investment banker. The investment banker does something with that and then gives it to our deal team. Our deal team does something with that and then gives it to our investment committee. And you're sitting 6 or 7 layers removed from what is going on in the company. And then you're trying to make a decision on it. Investment committees are there to really look at exceptions, make sure that your principles are being followed, make sure that there's something really bizarre here going on, and to help the deal team to pursue their mission. That's also very empowering to the deal team that behaves that way. So that is what we mean by a decentralized way of operating. That is why we have our middle market fund. They do the same as flagship, but you need a dedicated team because middle market competitors are different than flagship. The way they talk, the community, the deal pace, it's a bit different. That's a little bit different than growth. So we put dedicated but not separate teams in each category that can move with their market and that own that process. I think the main thing on motivating teams is you give them support when they need to. Support. You don't do something for them because they are the CEOs, they're the boss. And number 2, you give them that path to be able to create and be future leaders, which you have many of those.
Right. I could keep going, but Megan is going to have my chop, so I will end there. I want to thank you, Orlando. Thank you for being here today. Just to end, at the end of this event, you will all notice, or you will all receive a survey about today's event. Your feedback is greatly appreciated, which helps the society plan future events. If you have any comments about today's event, please contact CFA Society at info@cfachicago.org. Please join me and give me a round of applause to Orlando Bravo. Thank you.
Thank you. Thanks so much. We appreciate it. Thanks, man. Nicely done. That was awesome. Nice meeting you. Thank you so much. Thank you. Thank you so much. Anytime. Thank you.